Hey, this is Jeff Baxter from MidStreet, and this is video 3 in the Small Business Valuation Essentials course, where we talk about EBITDA and how it affects business valuation. So let's jump right in. So EBITDA is a measure of profit that's used in lower middle market companies and less frequently smaller deals like Main Street deals to compare the profit between different businesses. So it's an acronym that stands for earnings before interest, taxes, depreciation, and amortization. So that means, taking a look on the right here, EBITDA is when you take your net income and you add back the interest, the taxes, the depreciation, the amortization to come up with that number. And so the purpose of this is when you add in those things like depreciation and amortization, you're getting rid of the non-cash expenses. The interest you want to get rid of because it's affected by the loans the business has and not the operations. And you want to add back in the taxes because different corporate structures have different effect on the taxes. So it kind of neutralizes all those different effects, which would be caused by management decisions, not necessarily the operations, so that you get a fair apples to apples comparison between different companies. So in the last video, we talked about seller's discretionary earnings, which is a metric that was invented by brokers to help business buyers understand how much money they would make owning and operating the business. So it has a very practical application, and that's where the definition comes from. It's designed to give you a good idea of what you would make. EBITDA, on the other hand, is really a more finance definition where it's pretty rigid. So when you're calculating EBITDA, those are the only adjustments that you'll make. And we'll talk about later why that might not necessarily be the right tool to use for every job. But EBITDA is very widely used in private company valuation, especially deals over 10 million in value or $1.5 million to 2 million in earnings. It's the most common metric for that business size. So we have a quick example on the next slide though here. So say that you chose to use EBITDA to value a business, or say that you owned a business and you had assembled a really good management team that allowed you to only work 20 hours a week. So this is the goal for most business owners, right? You only have to come in 20 hours a week, and you own this great company. But your CPA told you that it's probably a good idea to pay yourself a salary of $300,000 a year. And the reason for this is you're making good money. You're making $750,000 in EBITDA at the end of the year, and they want to make sure that you don't get audited. So that's a common thing CPAs will have you do, is pay yourself a decent salary and pay those payroll taxes so that you don't get audited. But what if your CPA had recommended to you that you only pay yourself $200,000? Well, that would have raised your EBITDA from $750,000 to $850,000. Did that make your business more valuable? Well, obviously not. It's the same company making the same amount of money, but that shows you the difference between EBITDA and adjusted EBITDA. So the purpose of adjusted EBITDA is to take out some of these expenses that are particular to one owner so that you can neutralize the effect that those decisions have. So the most common adjustment that you make when going from EBITDA to adjusted EBITDA is the owner's salary. So in the last example, we had that company doing $750,000 in EBITDA. Say that company did $4 million in revenue, and say that you paid yourself $300,000 a year to do that 20-hour-a-week role. That seems a little bit high, in my opinion. So as a valuation specialist, what I would choose to do is lower that $300,000, which raises the EBITDA by adding back that salary to make it a more fair salary for the position that's being done. So in this case, we could say a competent manager to do that role would be $200,000 a year. So we're going to add back that $100,000 into the EBITDA. So you can see here on the right, the concept of adjusted EBITDA works the same, but you'll see down at the bottom, we have the standard EBITDA adjustments here, and then you have that one-time owner salary adjustment, and then we have another adjustment here for a one-time expense. So this is to show you that similar to SDE, you'll add back any one-time expenses like, say that $25,000 was an employee ran the forklift into, like the door, the roll-up door, and so you had to replace it, and that's never happened before. So you don't want that to skew the EBITDA, so we'll add that back as well. So this should say adjusted EBITDA down here. Now that you understand the concepts of EBITDA and SDE from the last video and the beginning of this video, we can start to compare them and see where the two would get used in different valuation scenarios. So SDE, going back to the definition, is how much one owner-operator would make operating the business as a full-time employee in the business. So you own a company and you operate it, and your salary is part of the SDE. EBITDA, on the other hand, is a measure if you had a management team in place and you owned the business as an investment. So in SDE, you add back a manager or owner's salary, but in EBITDA, you do not. You would adjust any owners or manager salaries to be market rate. SDE is typically used by businesses with less than $1 million in earnings. You will see it used up to $1.5 million sometimes. And EBITDA is typically used by businesses with over $1 million in earnings, almost always above $1.5 million. It starts to become the dominant valuation technique over $1.5 million up until you get to public market sales, where you start to use price to earnings ratios and things like that. So SDE is typically used by individual buyers. EBITDA is typically used by private equity groups and strategic buyers. So if you're valuing a business and it does $1.2 million in cash flow, let's say, and you've adjusted the owner's salary to be a market rate, and you're thinking about which should you choose, well, the next best thing to think about is who the buyer is going to be. If this is a business that has the characteristics of a strategic or private equity play, say it's a manufacturing business with a really niche set of skills and a customer base that might be interested in acquiring it, then you're probably going to want to use EBITDA in that situation. If it was a company that's a little bit more Main Street but has outgrown the typical SDE size range, for instance, a company we've worked with would be a roofing business that does quite a bit in cash flow, but it's probably not going to sell to a strategic or private equity. You would still want to use SDE even though it's over $1 million. And then lastly, SDE is always higher than EBITDA inherently as a part of the definition, because it's effectively the same as saying EBITDA minus that manager salary, or EBITDA is equal to SDE minus a fair market manager salary. And so for more information on this topic, if you want more examples or you want to see a direct comparison of one business where we're going to calculate the SDE and the EBITDA off of the same set of books, this blog down here at the bottom, midstreet.com/blog/SDE versus EBITDA, or if you just Google SDE versus EBITDA, it should be the first thing to come up. That'll give you some really good examples to utilize. So moving on, we have one more quick example. It's kind of the same thing. So an example of a company for SDE would be a landscaping business doing $4 million in revenue, where the owner is in the business. Most likely buyers an individual using the SBA 7A loan program, which we'll talk about in later videos. So those banks, following the SOPs, the standard operating procedures of the SBA loan program, are required to use SDE. So that's what you're going to see for that business. An example of a business that would almost certainly be valued using EBITDA is a manufacturing business that does $12 million in revenue. So for that business, it's almost certainly going to go to a private equity group or a strategic, and that's going to allow those groups to compare evenly across different potential targets, and it's also going to make the multiples make sense, because most of the comps that we'll find in the next video are going to be based around an EBITDA multiple for businesses that size. So now we can take a look at a set of financials that I have here from a valuation I performed. This is a valuation for a business that came to us wanting to sell at MidStreet a couple years ago, and I've scrubbed their identifiable information from the valuation so that we can use the numbers as an example. So going down here, This information is from a tax return, so you'll see it follows the format of an 1120S. And we'll just get started here, going down, starting from the top of the expenses. So the first expense that we have to adjust is the officer salary. So this business doing $12 million in revenue, the owner paid himself $554,000, and this was for one owner. So looking at that, knowing what I know about the business through the questions that we asked in the valuation process, I know that this owner works about 30 hours a week. In really any situation, that's going to be a salary in a lower middle market business that needs to be adjusted down for a manager. So because we're trying to calculate adjusted EBITDA, we want the owner's salary to be equivalent to what a fair market manager salary would be. So in speaking with the owner, they suggested $125,000, so that's what we've reduced that to. That might seem low, but it really comes down to their discretion of what they think a fair salary would be. And we'll help them come up with a number. Last point on this is you want this to be a fully loaded number as well. So if you expect them to take health insurance, 401k matching, any other profit sharing, bonuses, pension, any type of program that you expect to pay for, you want to be reflected in this salary. So you might want to make this a little bit higher than what the just pure dollar value you would expect to pay. Okay. In this case, we have a big one-time adjustment here. So you'll see this repairs and maintenance of $557,000. The owner felt like that was a one-time occurrence, and we would fact check this going through the valuation process. They felt like that was something that wasn't going to happen again. It was a piece of equipment that catastrophically failed or something, and has never happened in the life of the business. So we would add back that cost or some of that cost to get you to a normalized repairs and maintenance value. So now looking at the rent, this business owner owns the real estate that the business is operated from, and they were underpaying themselves compared to what they felt a fair market rent was. So we made a negative adjustment to increase this value to what they felt a fair market rent was. The taxes and licenses, similar to the last video, is equal to the payroll taxes, specifically the employer portion paid by the business on this officer's salary. The standard EBITDA adjustments are made here: interest, depreciation, amortization, and pension and profit sharing. This would be the owner's 401k portion, the employer match or employer contribution, and then the employee benefit program is the the owner's health insurance paid by the company. And this is another one-time expense of office supplies. I'm not sure, we can take a look at the note down here. That was a office repair expense. So something might have happened in the office that necessitated big repairs that were not covered by insurance. So the owner gave us the documentation on this, and then we looked at it and said, okay, that's a legitimate one-time expense. You want to be careful. You really can get bitten there if it isn't legitimate, and buyers are certainly going to do extensive due diligence into whatever add backs you make. So it's best to get the documentation now and be certain that it's a legitimate add back. So coming down here to the bottom, we'll see that that went from $514,000 in net profit on the bottom of the tax return to $1.6 million in adjusted EBITDA. And that's pretty normal to have a big increase like that. I would say that's a little bit more than I would have expected. Typically, you'll see a couple $100,000 at least because of the officer's salary. But the most important thing when recasting financials is to get the documentation early and ask a lot of questions. If you make adjustments or you make add backs that turn out to be unsubstantiated, it can be really hard to reel in that expectation for the buyer. Once they think that the cash flow is at a certain level, they've established a value, or they've submitted an LOI or under contract at a certain price because we put that SDE out there or that EBITDA out there at a certain level. So just something to think about when you're looking at add backs. Try to scrutinize them in pretty good detail, and we'll talk about in later videos what would be considered a legitimate add back versus not legitimate when it comes to valuing a small business. But hopefully this gave you a good idea of EBITDA and how to calculate adjusted EBITDA and when to pick between SDE and EBITDA in a small business valuation. In the next video, we're going to talk about how to come up with a weighted average number for earnings, and then dive into comparables and how to find the right comps to come up with the right multiple to value a small business. So thank you for watching this video, and I look forward to seeing you in the next one.